What's going on, guys? Welcome to The Journey, where we deep dive all things real estate and investing. We pick the brains of market leaders in their field. That way we can fast forward you from where you are to where you want to be using their knowledge and experience. My name is Austin Mitchell, and today joining me is Chris Bray. He is a leading commercial lender in the area. He was a professional baseball player before he got into lending. He manages $70 million worth of commercial real estate. And today specifically, we're going to be talking about owner-occupied commercial real estate and multifamily investment. So super excited about that. First, let's hear a little bit from Chris, his background. So was a professional baseball player. So obviously we're going to start with that before he got into this game. So Chris, please tell us how did that all go down and how was that journey?
Oh, wow. Long journey. Knew at a very young age that I was gifted. From basically, my parents asked me what I wanted to be when I grew up, like every parent does.
Right.
And at 4 years old, I told them I wanted to be a professional baseball player.
Yeah.
Pursued that dream relentlessly all the way through high school. Was blessed enough to get a scholarship to attend University of Mount Olive in North Carolina. Got drafted my junior year. Had an outstanding career. In college, was actually predicted late first round or early second round draft pick coming out of college. Went up to the Cape Cod League, which is a major league invitation only. Just to put that into perspective, I don't know if you know baseball that much, but or follow anybody, but Nomar Garcia-Parra, Jason Varitek, and Darren Erstad were all on my team, and those guys all turned out to be Hall of Fame players.
Right. Oh, that's awesome.
Granted, I'm not in the same ballpark as those guys. No pun intended there. But ended up coming back my junior year to play in college, and about a month before the end of the season, I had a partial tear in my ulnar collateral ligament, and it sent my draft status just plummeting.
All right.
Was blessed enough to get drafted anyway. Rehabbed it and went on and played. Got drafted in '95 and played until 2001, when ultimately back surgeries ended my career. Growing up on the Outer Banks of North Carolina, you do several things. You either fish, you surf, or you play a sport.
Right.
And I surfed, and I played a sport, and I fished.
You did it all.
So after my career was over, in between baseball seasons, I always worked at the local surf shops, and ended up doing that for a few years after my baseball career was over with, but realized very quickly that there's not a lot of longevity for a late 20-something, early 30-something to have a good career in that. So moved to Wilmington, North Carolina, and got into retirement planning with a company called Bankers Life and Casualty. Got all my licenses with life insurance, Medicare supplements, long-term care. I became a certified long-term care specialist. And at the time, out of the 160 branches that were in the country, the branch in Wilmington was ranked number 7 in the country. Big retirement area. So a lot of snowbirds from up north want to come down. They can sell their home up in the north and get a much bigger home down south.
Just cash out.
Exactly. So I did very well there, and then went through a divorce at that time and realized I was like, there's no reason for me to be down in North Carolina here anymore. All my family and friends are up in northeastern North Carolina and southeastern Virginia. So I was like, let me get back up that way. And got back up, transferred within Bankers Life and Casualty to the Norfolk office. Well, Norfolk is not a big retirement area. Out of 160 branches, there was 162 actually. The one in Norfolk was ranked 161, and it became very difficult to do retirement issues, especially when the company the parent company that owned Bankers Life and Casualty is called Conseco, bought a company called Green Tree Mortgage, which financed mobile homes.
Okay.
Well, that went bankrupt.
Oh no.
And it caused our AM Best grade to go from an A+ down to a C-. That became even more difficult to convince somebody to, hey, come work with me and let me help you out when they don't know if my company's going to be around much longer. So I ended up walking into Wells Fargo one day. That's who I primarily banked with, and I was just like, hey, you guys hiring?
Yeah.
And sure enough, they were. I went online and got a call within the end of the day, for an interview, and went in and interviewed, I don't know, a couple of weeks later, and got the position. Started out as a personal banker, and then worked my way up to a business specialist.
Right.
And did that within a very short period of time, within 2.5-3 years.
Wow.
Starting in 2009. And Did very well.
Yeah,
did very well. And then had an opportunity to go over to another community bank. Getting out of the corporate banking world and going to a community bank was life-changing. Very eye-opening, completely different from massive big banks to community banks, and I loved it.
Okay.
Loved community banking. The folks that you work with are much more personable. You get to really have a relationship with your community.
Right.
You get to have that one-on-one time. You get to go visit their operations and see how they do things instead of just studying an appointment, come in and having somebody sit down in your office and talk about what it is.
Yeah.
It's much more enjoyable for everybody to go see them in their element. And let's face it, business owners love to talk about their business. So I would be happy to go see anybody to talk about their business and see how I can help them out. But transitioning into working my way up the ladder, corporate bank to community bank to community bank to community bank, and now I'm with Cooperative Business Services, and I absolutely love it.
Right.
It's a great institution, headquartered in Cincinnati, Ohio, but we're all over 16 states, and work with 150 credit unions throughout the country.
I'm sure that makes things easy.
Yeah.
Okay. Well, there's a lot to unpack there, so let's go ahead and undo that. So I know the timeline, you professional baseball player, got into banking 13 years ago, and then just worked your way up. 10 years ago, started commercial lending. Started with Wells Fargo, that was more corporate, went into community, liked the vibe a lot better, just a better place. And I feel like I can speak on all of that. First question is, do you deep sea fish or do you freshwater fish?
I go offshore.
Okay.
I'm going out there.
Long ways.
Freshwater is not my gig.
Yeah.
So I like to have something that can fight back a little bit harder.
Oh gosh, yeah. So I've always wanted to go deep sea. I grew up in the country, so I did a lot of freshwater, and then a handful of times I would go in saltwater, off the dock or something, in a Rappahannock. But no, you don't catch the 100-pounders. Not like deep sea fishing.
No, I tell people I work in lending or banking to pay for my fishing and hunting habits.
Right. Yeah, there you go.
It's not cheap.
Yeah. And then I definitely respect the community aspect that you found in a more community-sized bank. My background is in CrossFit, and if you know anything about CrossFit, the big buzzword there is community. So, I started out in the big box gyms, the 24 hours, and so to me, it's very similar to a corporate bank compared to a community bank. When you're in those, you're just treated like a number. It's not very intimate.
Exactly.
And I'll tell you from personal experience working with my bankers, the ones that I have direct contact with are everything. Like those are the ones that really mean the most. So definitely if you're going for any kind of lending, certainly look for a community, especially local.
Absolutely.
Commercial, come to Chris, he'll take care of you big time. So that's a background. It's amazing. And what we're going to do now is transition into the main topic for today, which was owner-occupied commercial real estate and apartment investments. Again, Chris manages over $70 million in investments right now. So he knows what he's doing. He knows what he's talking about. He's one of the leading 504 lenders. So that's owner-occupied SBA program, which is massive. If you are an owner-occupant, the SBA is massive. I know surface value for those deals is that it's 10% down.
Correct.
Compared to 20, which is what sucked me in the first time. There are a couple nuances that you need to be aware of, but no, overall it's a great program. So if you are getting into commercial, or if you do own a business that you need a commercial space, the 504 can certainly open up some doors for you. So again, I'm going to turn it back over to Chris, but we're going to dive deep into the owner-occupied commercial real estate. First, how did you get into that? And just speak to me on the investments that you manage right now.
Yeah, absolutely. So I kind of just happenstance got into really focusing on owner-occupied. Started at Wells Fargo, with folks coming into my office there that had a business that they just needed. Typically, some smaller loans. It started out with lines of credit and things of that nature, and then it evolved at Wells Fargo into actually financing the buildings. And then going into community banks, that's where I really started to focus. I kind of built a small portfolio at Wells Fargo. It's kind of hard to take things away in corporate banking, but I had a small group of folks that would follow me over to, at the time it was Southern Bank, and then where I went after Wells Fargo, and it just built from there. word of mouth, grassroots marketing, getting out, pounding the pavement.
Yep.
If you're not in the industry and you don't have the name, because I'm not from Hampton Roads, I'm not
Right.
from Tidewater, I'm a small town Outer Banks boy.
Yeah.
People don't know who I am up here.
Yeah.
And so I just got out and pounded the pavement, introduced myself, and met as many people as I could, attended as many networking events as I could, got myself involved and immersed in the community, and it just started snowballing from there. And then eventually it became more of a broad spectrum of things, as well as, in addition to owner-occupied, the multifamily things and industrial, and I just really enjoy doing all of it now.
Right.
But the owner-occupied space was just kind of where it just sort of started.
Yeah.
It's typically easier to get financing for owner-occupied stuff than it is for investment property.
Right.
A little bit less risk to the bank. So that's where you kind of wanted to start where I wanted to start my focus was on the owner occupied. And there's other programs out there that can help them. Like you mentioned, the 504. If you're 51% owner of the location or more, you can qualify for that 504 piece.
Yeah.
Rates are typically, the blended rate is going to be better because SBA is going to offer a different rate than the bank is going to offer. But then once that part is taken out, the 504 takes their portion out, then that rate is much lower than what the initial cost of entry was.
Yeah.
So it's really nice for the multiple programs out there for owner occupied.
Okay. Well, I mean, so that opens up a question. So if somebody is looking to, stop leasing or renting from their current location and they want to potentially purchase, what would you say would be good indicators that they would be a strong candidate to do so?
Looking at the performance of the property itself, obviously most people that own or occupy something aren't occupying all of it.
Right.
They're having some tenants, they're having some other person in there, some other entity in there to help pay for that mortgage or that leasing space. So kind of analyze what it is, look at the rent roll from the other tenants in the area or in that same facility, see how it's performing. Current market conditions are going to determine a lot of that. As we all well know, right now rates are going through the roof.
Yeah.
So it's a little difficult right now to convince somebody to stop leasing and start owning, even though I am extremely busy.
Yeah.
It's just taking a little bit longer to get things done. You just analyze the property, do your homework, have a pro forma, do projections, do them out 3, 4, 5 years, see how the property will look in 3 or 4 to 5 years, especially if you start to increase rents or if you take over 100% of the facility, because you can then, your entity can pay rent to the business. So
that's the sweet spot.
Then you'll start getting depreciation and all that benefit on your tax returns, which I'm not a tax professional, so I don't want to get too deep into that there. But there are benefits to owning versus renting.
100%.
Yeah.
Okay. Well, first, curiosity. What are the current rates? I haven't looked at the SBA in a while. Do you know?
Yeah, they fluctuate. We base most of our rates off the 5-year Treasury, and last I looked, the 5-year Treasury was at 4.1. It's starting to come down a little bit. It was at 4.6 not too long ago, but it's like hitting the moving target right now.
Yeah.
I mean, I could look at it right now, and it will be a 25 basis points different than what it was an hour ago.
Oh wow.
So it's drastically changing, and luckily, when we get a commitment letter put out to somebody who's looking to purchase a property, we have that rate locked for 60 days, and that's free of charge too. We do not charge for rate locks.
Yeah.
I know some institutions are, but we do not. In 60 days, typically you can close the loan within 60 days, and hopefully things are not going to change drastically with rates in that time, but even if they do, you can feel safe that that rate that we offered you at the time of the commitment letter being signed, it's going to stay at that rate.
Yeah. That's a major bonus. So if you've never done a deal, then it's hard to really value what Chris just said about locking that thing in for 60 days free of charge. Especially like to paint this picture on the residential side, like they don't do the lock until like that contract is signed. Like they won't. And so over the weekend you'll have, as he said, these huge shifts in these interest rates, and you have to take that, whether it's good or bad. Like it could change overnight. And when you're talking about 0.25% of an interest, like that can really change the cash flow. So
speaking of that, that's really where commercial lending we base most of our approvals off of. Cash is king.
Yeah.
The property has to cash flow. If it does not, then we have to get at a 1.25 times ratio, debt service coverage ratio, for us to approve you.
1.5?
1.25.
1.25.
Yeah. So basically what that means is for every dollar that you have in debt, you have $1.25 to pay the debt back. That's the minimum that they like to see. Now there's going to be other parameters that have to fall in line too. The performance of the property and the type of property. If it's a distressed property, we want to see that number a little bit higher. If you're not putting down a certain amount, minimum 20%, we like 25% on investment property. Owner occupied is a little bit easier to do. We can do 20% on that right there, meaning finance 80% of the purchase price,
right,
of the purchase contract. So yeah, it's challenging at times.
Well, honestly, that's a great metric, y'all. So, I mean, just for napkin math, if the all-in debt service, to pay back the loan is $1,000, and that would include principal, interest. Do you include
P&I.
Taxes?
P&I is what we call focused on.
So, principal and interest, that payment, you can just look up a simple amortization. Obviously you want to confirm with your commercial lender, but a amortization calculator, $1,000, you need to at least have rent at $1,250. Is that valid?
That's correct.
Okay. That's napkin math. Again, when I got into the game, I was not a commercial lender. When I went to purchase my building, it was, okay, what am I paying in rent? What's the interest rate right now on the loan? How many years are you going to amortize that? And then you can get your monthly payment. And I just saw there was a difference. I can make some money in the difference between paying my own payments and mortgage compared to rent. So that's really where, if you were going to go buy, as long as those numbers check out to where you're paying less to your debt as you would in rent, then it might be a good idea for you to buy it, to purchase it. Yeah. The big thing there is just obviously the money down.
Yeah, and a lot of commercial lenders and underwriters will analyze things on a global analysis too, not just property specific. Yes, we want to see the property specific cash flow, meaning that if you own this building that we're in right now, but you also have 2 or 3 other entities, we're going to analyze all those entities that you have 20% ownership or more in. If the debt service coverage ratio comes out higher than the 1.25, then you qualify. We also going to analyze just the property specific that you're looking to purchase or refinance.
Right.
That needs to cash flow. If it doesn't, I just need to have a good story as to why it's not cash flowing and what you plan on doing in the future to get it at least to a 1-to-1 ratio.
Right.
So that's kind of how it would work on the global analysis of things right there. If you own 20% or less, if you own 19% or less of a business, we just then look at the K1s, not the entire tax return.
Right. Okay. And I also think that's interesting. So if you own multiple, what Chris is saying, correct me if I'm wrong, is that if you own multiple, then the current one that you are assessing, he's willing to allow that one to cause a little drag if the other ones are performing until you can get it up. Very minimal. But if you have a legitimate plan to get there, you can use all of your assets to help qualify that one. So I think that
typically what we see is, especially in the multifamily piece. I know we're talking about owner occupied, but we can segue into multifamily here as well. That a lot of times when you're buying multifamily property, the rents have not changed drastically over the last 3 to 5 years, especially with COVID over the last couple of years.
Right.
A lot of the property owners weren't going to raise rents on somebody who's struggling to make a payment, especially in that financial climate that we just got through going through and are currently still going through with the economy and the way it is right now. So what will happen is they'll do a pro forma or projections in the event that they need to increase rents over the next 2, 3, 4, 5 years. And that's pretty standard. So what'll happen is we'll take a look at that property that is looking at being purchased, analyze what is current rents are and then what projected rents are. And we can actually come to a conclusion based on those projected rents. Granted, I'm not saying we're going to do projection lending,
right.
But we will take that into consideration to show, okay, listen, this is industry standard. The market shows that these properties are $200 to $300 a month, per unit under where the standard is. they can afford to increase rent from $1,400 a month to $1,600 a month, and not lose any tenants. So that's pretty much how that would come into play.
All right, if you want to see me geek out, this is my jam right here. So tell me, all right, so first, where do you get the market average? Where are you looking to kind of see that standard? If somebody's trying to assess, okay, well, I'm looking at a property and, I want to look what it's projected, where can you find the standard rents?
That is going to be on the pro forma or the offer memorandum that whatever brokerage is selling that property, they're going to have historical data. You can go on certain websites too, Norfolk Air, they'll have all kinds of information on there. The Virginia Beach websites, Suffolk, all of the 7 cities have their own information that you can go on and look up pretty much what most rents are going for in similar properties that you're looking to acquire or refinance. And then base your analysis off of that. Talk with your broker, talk with your agent, and then once everybody puts all their heads together and comes up with a quality solution, then that's presented to me. Then I can analyze that. Because I'm not going to be part of.
You get the polished. You get the polished. Okay.
I am not going to help you determine what market rent should be in a certain area. I can look at it and see if it's under, or I can look at it and see if it's over. But I can't offer. Okay, you need to increase this. I can't guide you as to what number it needs to be to get the number that I need to make the loan go through.
So when you come to Chris, make sure you have all your data together, honestly. And so I guess to speak on that, if you are curious, you can, just like Chris says, go put your hands on some offering memorandums. That's what they're called. A lot of big corporate entities, they'll put these together, especially the ones that do commercial properties, multifamily, commercials. They'll organize all these. You can get them from CoStar, but just talk to your brokers. They'll have access to these things. And then, you should have a partner if you're trying to get into investing in a commercial real estate. And they will have access to a CoStar or one of these services to where you can get these offering memorandums. But it would highly behoove you to download some of these and read them. See what kind of data they're putting out so you can start to understand how they analyze, what they look at. But exactly what Chris just said, it seems so simple, and it is on surface level, but
in theory.
But the footwork is really what makes commercial so complicated.
Correct.
It's just not as easy when you go on an MLS for residential. You could type in an address and you'll have 5 comps at your fingertips. It's not the same in commercial, especially when you're dealing with income properties, things of that nature. It's tough. But anyway, offering memorandums, take that nugget and just ask your broker to get your hands on a couple deals in the offering memorandums. But going back to this, when you finance, so you've done an $11.9 million deal. Was that an apartment?
It was multifamily.
Okay, please. So let's just dive into this if you don't mind. So what did that deal look like? I know that might be specific to that, but in general, what do you base the interest off of? What do you base the payments? I want to hear all about that deal.
It's going to be a factor of many different things there. So one, location of the property. Where is the property located? What's around it? Who's currently occupying it? What's the rent? What are the plans for it? All that is going to come. The cash flow, the liquidity of the borrower. We don't want to see you have $1 million property that's going to be the acquisition price, and you have $200,000 in the bank. And that's going to be your entire down payment there. So as soon as you take that $200,000 and put it on $1 million, what do you have left? We don't want to see you deplete your savings account, your investments, your 401k, your IRA, especially if you're underage. If you're under that certain age, you're going to take the tax hit, you're going to get penalized. Now you're putting yourself in an even more tight financial situation, and that is not what we want to see. So obviously the debt service coverage ratio is very important for us. A lot of folks talk to me about their debt to income, where commercial lending, debt to income is always important, but not nearly as important as it is in retail lending or residential lending, consumer lending. Somebody's trying to buy a house. You guys are going to look at that DTI pretty substantially. Not to mention the laws, make you. Where in commercial, no, that's not the case. We're looking at that DSCR. So we want to see vacancy. We factor in a 10% vacancy regardless, even if it is 100% occupied, and that's pretty standard across the board. In the event that you have 10 units and one of them decides to not renew their lease, now you're out that monthly income from that one specific unit right there. So we have to factor in that. That's conservative underwriting. That's pretty much going to be the industry standard no matter where you go. So those are several factors that are going to come into play. You know, property type, location, number of tenants, rent, debt service coverage ratio, liquidity, credit worthiness of the borrower, character of the borrower. I mean, you could have a borrower that has an 800 credit score, but you pull up their history and they got a couple of misdemeanors, or you know, there's some frivolous lifestyle living that you know we may want to ask a couple of questions on. Right. Those are things that we are going to look at. So we're not just looking at specifically the numbers only. We are looking at the character of the borrower. Okay. That's one of the 5 C's of care of lending.
Right. Right.
You know. So
I think that's a big deal. So I mean, before we come back to what that number is that you do look for on the debt service ratio, what are the things that you're looking for when you are evaluating character? Because I think that is something that is overlooked a lot of times, and I feel like that would be good to know if you...
Yeah, so that's a great question. At a few other institutions that I've worked at in the past, I've come across borrowers that have extravagant lifestyles. Luxury automobiles that are out of the norm. Yeah. You know, the McLarens, the Lamborghinis, the Ferraris, a helicopter, a plane. There was one financial institution I worked at that if you had a plane, they wouldn't finance you. It just, to them, it showed a extravagant lifestyle that you spend money on things that are really just super luxury items. Yes. That really do not benefit anybody but your own convenience. Yeah. So that's part of the character of somebody. Okay. We want to see somebody living within their means, clearly. Yeah, you want to be able to enjoy the fruits of your labor. You want to have the beautiful home if you can afford it. You want the nice vehicles. You want to be able to take a nice vacation once in a while. But you know, don't have the 10-car garage loaded with Ferraris and McLarens and Alfa Romeos, all these things like that. Aston Martins. You know, like what is the James Bond vehicles out there? And you go into some car auction that, you know, Fast and the Furious is now all of a sudden auctioning off all their vehicles, and you want to buy all of them. Yeah. That's a little bit extravagant there. So that's an extreme situation, of course, and it's rare that you come across that. But every now and then you will come across it. In addition to character, you know, we want to see that, you know, you have the basic stuff. Timely payments of your debt. You know, we don't want to see a bunch of 30, 60, 90-day lates. You know, things like that. These are standard you know, things that everybody should be doing, but not always do. And times dictate that. You know, sometimes we all make a little mistake here and there and go 30 days late. If we can talk to it, you know, you can explain it, then so be it. That's fine. Yeah. But yeah, that's to the character piece. We don't want to see an extravagant lifestyle.
Honestly, like I'm lit up inside because that is the most justice I feel like I've ever heard straight from the lender himself. So honestly, like I feel like that comes down to that whole work hard, be humble thing, and it is like you can't hide money, but like when people are constantly putting out and trying to be flashy, I feel like. And this can speak on to everything that's going on right now, social media and things of that nature. I feel like there is a false narrative being told when you are that person that is kind of flashy. And the lenders, it's not a plus anymore. So like you can impress the followers, but when it comes down to brass tack in business, like it's not a good look.
And we will look at social media accounts. Yeah. We will look and see what you're putting out there. If you're doing, I mean, I'm not going to tell the person's name, but they made a comment on social media one time about, I'm paraphrasing, of course, but something along the lines of like, money is never truly yours, so if you got it, spend it. And this person was trying to finance a pretty substantial amount of property and some equipment. And I saw that and I was like, well, man, what's up, man? You know, why are you putting this out there? You know, like, is this the kind of person that we're going to be dealing with?
So they look at that, and that you're hearing it, like they do look at that. So I don't, just keep your nose clean. Like I feel like it does come down to like work hard but stay humble. It doesn't need to be all that because it could come back and bite you in the butt later on in more ways than you could right now. But I think that's awesome. Going back to Yeah, because nobody speaks about that. Really, I'm thinking I've never heard anybody talk about the character piece in lending.
Yep.
You know, I think it's a
Well,
major
it goes
piece.
with anything. I mean, job interviews.
That was my first thought too. That's a big thing in job interviews.
You got to be careful what you put out there for
Yep.
people to see. You know,
Yeah.
you just can't just all of a sudden, arbitrarily throw some random comment out there and not expect repercussions. Yes, freedom of speech. You can say whatever you want, but there's not
You can
freedom.
lend who you
There's not
want.
freedom of consequences. You know,
Yeah.
you can say whatever you want, but now you got to deal with those consequences if they come back on you.
Exactly.
So,
Well, so before we move on, then the final piece in character. If somebody hasn't, so what is your kind of stance on new to investing? If they're trying to get into multifamily, but they've never done a multifamily deal, what backgrounds do you look for in them to have a level of trust?
great question. We want to see that you know what you're doing, that this is not your first rodeo. A lot of institutions, especially nowadays, today's climate, are going to see that you have performance in that specific space.
Okay.
If you're going to be getting into it right off the bat and be green about it, this is your very first multifamily, okay, what have you done in the past that gives us a level of confidence that you're going to be able to manage this property efficiently and to where it's going to be successful? Are you going to pay a property manager? Are you going to do it yourself? You know, and if you are, what experience do you have in the past that leads us to believe that you're going to do a great job at this one here?
Right.
Especially if it's borderline. If you're at that 1.25, 1.26 debt service coverage ratio, where you're barely making it, if you lose a tenant, how are you going to manage this? How are you going to market this property to get a tenant in there to get you back to where you need to be?
Right.
What happens if all of a sudden water pipes break? You know, a hot water heater goes. What, you know, all of a sudden the pavement's got to be repaved, tar on the roof, whatever it may be that needs to be done. How are you going to manage that? How are you going to pay for that?
Right.
What are you going to do with the tenants if they have to be put elsewhere for a period of time? There's asbestos in a building, especially in Norfolk.
Yeah.
You know, downtown areas down there, you know, there's some older properties down there that are beautiful buildings, but some of them have asbestos. You know, how are you going to pay for those folks to, you know, have an apartment or a hotel room for a few weeks, if not a few months? You know, how are you going to manage that?
Yeah.
So we want to see all of these factors to come into play, and ideally, you need to have a game plan.
Right.
I would hope so.
Yeah.
Most people would go into something like this and not just, okay, I got $1 million in my pocket and burning a hole.
Right.
You know, let me go out and buy something. My buddy says real estate's a great way to do it, so let's do it.
Yeah.
You know, all right, no, it's a little more to it than that. You
Yeah.
know, there's a lot of what ifs, and you better have a contingency plan and then another plan to back up that plan.
Right. That's good. Yeah. So, I mean, I think it comes down to like you got to go all in. Like you can't just have money and then just come into the game, because no banker is going to look and just say, they don't just look at the money in your account. They're looking at the person who is going to be leading that charge. And if they have big business acumen, do they have contingency plans? Do they have connections? Like that. So if you're trying to get into this game, you need to have those merits. Like,
Absolutely.
And how would you weigh somebody who has been, you know, a business owner compared to somebody who's been W-2 all their life? Like, do you look at that from a mentality standpoint, or like how they...
Depends on what they did.
Okay.
Yeah.
Well, yeah, obviously.
It depends on what, you know, if they were a W-2 in a certain business and they're looking to buy a business that's what they've been working in,
Right.
then we have a level of comfortable,
Yeah.
feeling there that we can actually work with them and get home on that deal.
Yeah.
Now, if let's say all of a sudden you're a veterinarian and all of a sudden you want to become a horticulturist or something.
Yeah, right, yeah. I don't know.
We may have a few questions there. Yes, you have intellect, you're an intelligent person, you know what you're doing, but this is totally different than the field of business that you've been in for a long period of time.
Yeah.
So we just got to get comfortable, and this is the beauty of a community institution, a community bank, is you really get to know the people that you're working with. It's not just, pardon the expression, but cheeks in a seat.
Yep.
You're not just sitting there across the table having a conversation with somebody. You're actually going to their place of business and having them walk you through their daily routine. What happens in this situation right here? Ooh, that's a pretty cool piece of equipment. What's that for? How was little Timmy doing? Is he still playing soccer? You can really have a great relationship with these folks and build lasting relationships. And sure enough, man, you daggone need to take it out to lunch or coffee once in a while too.
Yeah, right.
You know, I mean, if these people are going to come to you they can choose anybody in the area. There's tons of commercial lenders in this area, and they're all really good. There's some great folks in this area that really know what they're doing. But they came to you. They came to me. You know, I need to support them.
Right.
You know, I need to patronize their business.
Yeah.
I need to take them to lunch and show my appreciation for them. Here's some coffee. Here's, you know, it doesn't take much, man.
Yeah.
Just, you know, you let somebody know they're appreciated.
Yeah.
They'll be loyal.
Yeah.
You know.
Take note of that. So Chris was obviously speaking from his standpoint, but like if you're an investor and you don't have experience in this game, like a commercial lender just like Chris, that's your chance to like create a personal relationship and sell yourself more so than your past experience. And so the same thing he was saying about doing, you need to do that to the lenders because they are your golden ticket into this game, especially if you don't have investors lined up, if you don't have, you know, a huge nest egg to sit on. So yes, I think the character thing, that's great. This turned more into character, but like I think it's a major thing, especially if you're getting in because
character's huge.
Yeah, everyone's looking for opportunities, but it ultimately comes down to you, how you carry yourself, how you present yourself when you are meeting commercial lenders, when you are meeting investors, when you are meeting anyone who's going to be anything in your business. You have to be able to come and present yourself in a way that promotes confidence in you. So that's a huge deal. Let's talk about, I want to know, what are the numbers that you're looking for as far as the debt to service ratio? So obviously you don't want to clear out the savings, but what are those numbers you look for?
The debt service coverage ratio needs to be a minimum of 1.25.
Okay.
Yeah, that's our bare minimum. Obviously, the higher that number, the better. Typically speaking, on the average, most of my folks that I'm working with are around 175, 2. That's a strong number.
Yeah. Okay.
Anything 2 and over is strong.
We're good. Right.
Yeah, we're golden. Yeah.
Wonderful.
We want to see liquidity. You know, we want to see that you're not going to deplete the savings and all of a sudden, you know, your spouse is wondering where all the money went.
Yeah.
You know? Yeah. You know, so we don't want to see you deplete your life's earnings,
right?
You know, your life savings. We want to see some money left in the bank after you put the money down on the property. Okay. We don't want to see you depleting retirement accounts. You know, that's a big no-no. Because obviously most of us are still in our working years. Right. You know, you got to pay that penalty and then taxes on top of that.
Absolutely.
We don't want to put anybody in a financial burden. You know, that's the last thing that we want to do. Yeah. So we will underwrite conservative. Like I say, you get that 175 to 2, you're good. Yeah. You're golden. Cool. Yeah.
And so, I mean, the lending process can be arduous and it can seem frustrating when the lender is telling you no, but you need to understand they have your best interest in mind. Just like Chris is saying, like he's not going to make you spend every last dollar that you have because while you might want this tremendously, he knows that just it's not going to put you in a good position. Right. So as long as you have twice the amount that you're going to put down in savings, then you should and not dipping into any kind of retirement or anything like that, then you should be in a good position to where you could qualify for these things and be healthy. Yeah. Right. Yeah. So that's what he's looking for. So if you wanted to do your homework before you come speak to Chris, like that's what you're looking for. Have twice the amount and you shouldn't run into any issues there. Okay. And then, all right, so tell me about I guess we don't want to get too much into the specifics on that deal. I know the rules and things. But was that local?
Yeah.
Okay.
Yeah.
Can you share that?
It was in Norfolk.
Okay. Yeah. Was it a lot of units?
It was 12.
12 units?
Yeah.
Okay, for $11 million?
Yeah.
Good gracious. So this was like a class A.
It was
like this was complete turnkey.
It was very nice.
Okay.
It was very nice. Yeah.
Spot on. Nice. Okay. Yeah. So I don't know where you are in your investment journey. You know, you might be looking at distressed properties or value add or turnkey like that. Yeah. I think $1 million a unit. Yeah. Sizable. That's very sizable. But anyway, okay, so we won't dip into that. But how about, let's see, let's move on into if somebody wanted to get into investing, what would you think would be their best first move? How do you think they can get into the game?
Identify the property first.
Okay.
Identify the type of property that you were looking to invest in. A duplex, quad. typically somebody's first foray into multifamily is going to be on the smaller scale. They're not going to be looking at a 10 plus unit.
Right.
And even though 10's kind of small too.
But crushing dreams out here. If you got 10,
usually they're going to start with a quad.
Yeah.
Quad, maybe a 6, 8, something like that.
Okay.
But identify the property that you want to purchase. Talk to your agent. Get with your broker, whoever you're working with. Do your homework. A lot of times folks have a massive fear of failure when this is their first time going into something like this, because we're all scared of the unknown. And the way the market is right now, there's so much uncertainty with real estate, and things are going up one minute, they're coming down. And appraisals, my gosh knows, appraisals are taking forever to get done right now. And they're expensive.
Yeah.
They're not cheap, and then sometimes they come back lower than where you expected, and then the borrower wants to have another appraisal done, and then they got to pay for that stuff. So identify the property, work with your broker, eliminate as much fear as you can by really doing your homework on these things. Look at the pro forma, look at the historical data of the property, analyze it to the nth degree.
Right.
Do projections 3 to 5 years out, see how the property intends to perform, or how you would intend it to perform over the next half decade, and then make an educated decision from there.
Okay.
That's probably going to be my best advice on something of that right there. Do your homework.
Yeah.
And that's the case in just about anything.
Yeah.
I mean, it's rare that you find somebody who's got that golden horseshoe around their neck.
Yeah.
Whatever they touch turns into, oogles of money.
Yeah.
So you don't want to go down that road and just shoot from the hip and hope for the best. No, do your homework on it, analyze the property, and make sure you got the money, and be prepared for a ton of follow-up questions. So when it does get to the point where you're coming to me and you're asking for the money, I will put together all the packages that I need, the financial, the tax returns, the personal financial statement, the rent roll, the pro forma, the projections, everything. I will look at that and I will do my initial underwriting of that. But once I get to that and it looks good, I'm going to send it to my chief credit officer, my lead underwriter, and they're going to really do a deep dive, and they're going to have a bunch of questions. Credit guys are totally different than the lenders. A lender has never met a deal that we don't want to do.
Exactly.
Everything, yes, let's do it, looks good. Credit guys have never met a deal that they want to do. The holy, the answer with credit guys is no until you prove it yes. That is so true. So they're going to have a bunch of questions, and be prepared for the lender to come back to you and ask these questions. Well, I've already answered that. Well, no, not really. In a roundabout way, you may have touched on it, but now that's opened up this box of questions over here. So, and it's going to be perpetual. So whenever we come back to you, just be prepared. It takes some time. We're talking multi-millions of dollars here. We're just not going to say, here's a blank check, go have fun. We're going to analyze this. We're going to make sure that it's right for you. It's going to be a mitigated risk to the bank. And you can support the debt. Because the last thing we want to do is go out and foreclose on a property and start getting you behind, especially if it's something like a church. Heaven forbid, you got to go out and shut the church down. My goodness, now that's a bad PR. Right there.
These guys,
So I mean, you got to analyze this stuff. Granted, I don't do many churches. I've only done 2 churches ever.
It's not common, but
there are certain businesses out there where if you have to go and close the doors on them, that's bad PR. And we don't want that. They don't want that.
It's just bad vibes all around.
So
to sum that up, it comes back down to just do your homework, like Chris said. I know. We talked about the character piece, knowing how to carry yourself, but that's your oral exam. They're going to come back and ask you 100 questions, and that's where they're going to see, did you do your homework or not? And you need to know your numbers, you need to know what business you're getting in, you need to have the contingency plans, you need to know the people you need to know, and all these things go into that. And if you haven't done that homework and you truly aren't treating this like a business, then they're going to see right through it. They know what questions to ask that expose you. So it really comes down to, on this part, there is no easy way. You just need to be in it. You need to do the research. You need to learn the things so that way when you are given this oral exam,
Yep.
you have the answers.
Absolutely.
So to speak on the duplex, triplex, moving into the bigger commercial spaces, can you shed a little light on the difference as far as the down payments? Because that would shift as you get a little higher, right? From 20 to 25%.
Yeah, 25% on multifamily investment properties is where most financial institutions, us in particular, we like to see. It's a little bit more risk involved.
Yeah.
And then owner-occupied. Typically, when you have an owner-occupied facility, you're going to make sure that payment's taken care of.
Yeah.
Where if you start to get a little tight times and you have multifamily property, you may let that month slide.
Right.
So we're going to analyze that a little bit deeper, and we're going to require you to put a little bit more skin in the game.
Right.
Yeah.
Yep. And that's fair enough. And as you get bigger and bigger into these multifamily properties, the calculation and the way that the comps are taken, also the way that you evaluate their financial position changes, correct? Like
Correct.
it comes more, the bigger they get, the more income from the properties kind of goes into the calculation as opposed to a duplex or triplex.
Correct.
Yeah.
Correct. Typically, the larger the unit that you have, the rents are going to pay the projected mortgage.
Right.
So that's not always the case. That's why we underwrite on a global basis. But typically, the bigger the property, the bigger the apartment size, multifamily places like that, the larger they are, the more they're going to have the opportunity to pay the note.
Right. Okay. And that just comes down to know what game you're in. If you're in the smaller ones, know what you need to cover. You're going to be liable for most of those units. The bigger you get, then now it's treated different. The way that you take the numbers, the way that you write the deal, all those things change the bigger it gets. Chris, could you shed some light on where do you see the space in 5 years?
Good question. I recently attended a conference in Richmond, and it was geared towards the Richmond market, but Richmond and Norfolk are very similar in a lot of aspects. One of the speakers was very glasses half full, and the other one was the exact opposite, glasses half empty. Yeah. So you kind of have to take bits and pieces from both and come up with your own conclusions, and of course with your own experience and analyzing your own market to determine what's going to happen. I personally see in the next 12 to 16, 18 months the ship starting to right itself. I think after the November elections, we're going to probably see some changes, positive or negative. Don't know. I don't want to get into that, that rabbit hole. Yeah. But obviously, in certain administrations, when they change hands, it affects the economy. Currently, we can see that. Yeah. So I think over the next year, I would think by Q3 of next year, Q4 of next year, we'll see some positive changes, rates kind of stabilizing. The dollar right now is the strongest it's been in 30 some odd years. So yes, that's a good thing, but it's also a bad thing for other countries around the world. They can't afford to import our products because our dollar is so strong. But it's good for us because we can.
Well, that's our dollar. Yeah. We can do more with it.
Right. I'm getting into a whole tangent there with that, but rates will probably stabilize in the next 12 months. I think that we're going to start seeing things normalize. It has to. Right. It can't keep this pace. Fed's talking about raising rates again in November to combat inflation. At some point, there is going to be a ceiling. It cannot keep going the way it's going because it's just going to destroy the economy. And we do not. They don't want that. No. We don't want that. Yeah. Nobody wants to see that happen. But give it a year. I would say Q3 of next year, we'll start seeing things normalize. And I think a big part of the investment on real estate is going to be the multifamily. I think the multifamily is going to really kind of get us out of this hole. Yeah. I really do. We personally, my institution, we love multifamily. Yeah. Which is opposite of where I've worked in the past. Yeah. So it's each institution has their level that they like to play in, or their sandbox they want to play in. Yeah. We like multifamily, and everyone likes owner occupied. That's easy. But the multifamily stuff, we have a good niche with it. We know it well. The people the credit unions that we work with, we partner with, they know it well, and it's performing very well. Yeah. What was the statistic? I can't remember right now, but millennials all the kids coming out of college and so forth as well, they're not buying right now, they're renting. So everywhere, and just look around here in southeastern Virginia, what's going on with apartments? They're popping up everywhere.
Yep.
So I mean, they wouldn't be building these places if they weren't going to be occupied.
Yeah.
So renting is the big thing right now. So getting invested in multifamily properties is going to be a good thing for a lot of folks here in the future. So.
Well, there you go. So you're watching the right episode, because that's what this is about. Obviously getting into multifamily, so we're getting a year head start. Just to speak on the population, we have the top 3 right here in Norfolk, Virginia Beach. We have the top 3 cities as far as population in Virginia. So we've got the people to occupy.
Virginia Beach alone is the biggest city in the state of Virginia.
And it's almost twice as big as the second, which is Norfolk.
Yep.
And so major opportunities here. If it seems crowded, it's not. It's fine. Everybody can do anything. But one quick last tactical thing before we close this out. When, commercial rates versus residential rates, I've gotten a ballpark from a couple people of where they think it's gonna normalize around 5%, high fives-ish for the residential in a year or so. Do you think that would run parallel with commercial, or do you think it'll be lower?
Lower.
Okay.
Yeah.
Does commercial generally run lower or higher
Commercial
than
generally
residential?
runs lower.
Awesome.
Yeah, commercial generally runs lower. Typically, because you're in a competitive bid. We're going up against 2-3 other financial institutions, so we want to win the deal.
Right.
And most people that are looking to invest in this, please don't just put all your eggs in one basket. I want to win the deal, but we could get down this investment, analysis and get into the 11th hour of this and realize, all right, this is not going to work. And then now this person's 30 days into their 45-day due diligence,
Right.
and they're, oh my gosh, what do I do? They got to scramble to find another financial institution. So have 2 or 3 going at one time.
Right.
That way competition's healthy.
Yeah.
And I'm all about some competition.
Yeah, there you go. Hey, professional baseball player. It's in his blood.
So just do your due diligence.
Right. Yeah. So even something as simple as that, when it comes down to it, when you go to find a lender, you'll look around, you'll look at 4 or 5, but truly everything in you is going to be all right, well, I'll find the one and that's the one. But you can't, you've got to do that for 2 or 3 different lenders. And then at the end of the day, you'll really get the best scenario out of that. So as Chris said, he likes competition. So give him a little reason to run.
There you go.
So final question before we close this out. I always like to ask, Chris, what is your most influential book or mentor in business?
Great question. First off, my father. He was a banker, and I grew up watching him as a child all the way until he retired. And not gonna lie, had a pretty good youth. My growing up, my childhood I did not go without. So I wanted to be able to provide for my family as well. And my father is by far and away my greatest inspiration, will always be. Directly, 2 people stand out. One is Stephen Bird.
Okay.
I cannot say enough good things about that man.
Yeah.
We worked together at a financial institution, it was 2014, and stayed together for about a good 5 years over there. And then he left to go to another one, became the president of that bank, and he brought me over with him. Taught me so much about risk, analyzing the risk, how to analyze a property and see what a good property looks like. And he was just always in my corner. So he really had my back and took me under his wing. And what's great about him was he worked in mortgage, residential mortgage for a while before he got into commercial. So he knew both sides of the game and could really speak intelligently on all aspects of lending and types of properties. Stephen was a big mentor in my life. Second would be Trent Dudley. Okay. He's the regional president for a local institution here, and again, same lines as Stephen Bird. Really just nuts and bolts, every I dotted, every T crossed. He really knows what he's talking about. Great man. And both of these guys are of extremely high moral fiber. I mean, their ethics are unparalleled. I can't ever recall anybody saying or complaining about anything that they have done wrong. I'm sure they've rubbed a few people wrong along the way. You're not going to say yes to every deal you come across, and that person's going to be upset. That happens. But they both had a phrase that stuck out in my mind, and it still to this very day sticks out when it comes to lending. It's good to give somebody a quick no than a long drawn out maybe.
Right.
You know, so when you come to me and I look at the financials and I can do a pretty quick analysis, I would be safe to say that I can give you a quick yes or no. No,
yeah.
I can't give you a yes just yet, but
Let's do it.
I can give you a quick no instead of a long, drawn out 45-day maybe. Maybe we can get this done. I got to ask a few more questions. Now it's just upsetting the borrower.
Yeah.
You know, so that's the last thing you want to do is run over their due diligence period, because then they may have to throw in an extra $3,000, $5,000, $6,000 to extend that contract, and now you got an upset seller, the borrower's upset, nobody's happy. So those two have really been a big influence directly into my lending career. But yeah, I can't say enough good things about those guys.
I appreciate you sharing that. Is there a book that you would recommend?
Two books I liked a lot.
Okay.
One is the former CEO of Disney, Robert Iger.
Okay.
Great book.
Okay.
It was The Ride of a Lifetime.
Okay.
Basically talks about his career at CBS when he started just as, I believe he was a key grip. You know, somebody just held the mic up over him.
Right, yeah.
And then worked his way up the chain and became the CEO of Disney, and then was, of course, part of the Pixar acquisition and Disney with Star Wars.
Yeah.
And of course, opening up all the different Disney Worlds around the world.
Right.
And how he got to it, and just principles that he implemented along the way, and people that he helped out along the way, and he brought with him that knew would get him and the company where it needed to be, and where they foresaw the big picture on that.
Okay.
But
I love that.
Robert Iger was a great, and Jack Canfield's book, The Success Principles, is another good one as well. That's more of a salesy book, but there's some really good points in there that I liked a lot. Yeah.
Well, sales is very necessary, and I feel like in any game that you're playing. So awesome. I appreciate that. And then, Chris, if anybody wants to reach you, especially owner-occupied commercial real estate, multifamily investments, like how can they reach you? What would be the best way to get in contact with you?
Text messages is awesome. I love text messaging because I can multitask. I can be in a meeting and I can respond to text.
Yeah.
So my phone number, 910-262-0765. is the best way to get a hold of me, or email me, cbray@cbscuso.com, cbscuso.com.
Okay.
So that's the best way. And then, of course, I'm on Instagram, Facebook, LinkedIn, under my name, Chris Bray.
Okay. Chris Bray, any underscores or anything crazy? Nah. No, just straight up. Oh, so you got it. You got the original name. Nice.
And my profiles are all public.
Awesome.
So I don't put anything out there that I don't want.
Yeah.
Going back to Trent Dudley, one of my mentors, he was like, Harry, don't ever put anything out there on social media or an email that you would not be afraid to read back if you were on the court of being questioned by an attorney.
That would make you very uncomfortable. Yes.
So, and your grandmother and parents are in the crowd listening to everything.
Valid advice.
Yeah.
Well, perfect. So any of those contacts, we'll put them in the description as well. But please, yes, any questions you have, reach out to Chris. If you need to be connected with somebody, you can reach out to me, just austinmitchell.biz/thejourney, the podcast, the YouTube, all those resources are there for you as well to progress your real estate and investing. And Chris, I just want to thank you. It's been an absolute pleasure.
Thank you. I really appreciate it. Yeah, absolutely. Enjoyed this.
Yeah, and then hopefully we can do it again soon.
Yeah, absolutely.
All right, guys, we all have a great day, and we'll talk soon. Later.